silver got up to like near 59 in the spot. Customers are buying more silver at record prices, not less. King Kong the other day, Eric Young, expects that the higher the price goes, the more people are going to want it, like flaunting your wealth. But maybe at 100, 200, or even 300, it's going to be, could be the new gold.
I don't get the impression yet that there's any fever in China.
President Trump signed executive orders August 7th, 2025, democratizing access to alternative assets for 401k investors. They're talking about that they want to make commodities and direct and indirect investments in commodities. So I would say that's the physical commodity, i.e. gold and silver. Unlike IRAs, where I think people who do a lot of gold and silver IRAs, they can't do it on the 401ks. From February, it's highly possible that we could see a lot of money going into mining sector from 401k policies. Every time silver got up to like near 59 in the spot, we'd see an attack on it very, very sharply. And they took it down quite a bit yesterday as well, but it's like a beach ball almost. It keeps coming back up. It's at 58.25 now. It's been as high as 58.53 this morning. And I sent you something from a post from Bullion Star, and I'm going to share it here with you and the viewers. Bullion Star, they're in Singapore, of course, and it says, record silver prices aren't slowing demand, they're accelerating it. Lines formed outside our bullion center before we even opened. This week's silver sales are already up 84% versus last week, with 3 days still to go. Customers are buying more silver at record prices, not less. This is what real ground level physical demand looks like. And you thought that was interesting. You made a comment. Maybe you want to tell the viewers what you think that could imply in the future.
Well, of course, the two languages in Singapore are Mandarin and English. And so I'm kind of wondering if there's been some sort of social media event or something like that, or some video which has gone viral, which is causing people to line up and buy the silver.
Physical silver demand is quietly defying market manipulation. Despite spot attacks pushing silver down from near 59, Bullion Star reports sales up 84% week over week, reflecting robust retail appetite even at record prices. In Singapore, queues are forming before the store opens, suggesting grassroots demand is not just a headline figure, but tangible buying behavior. Viral social media or regional language influence could amplify this trend, potentially signaling wider Asian market participation. Investors should track such physical purchases as early indicators of price resilience. Next, Mario Innecco and Clive Thompson explore how this surge could signal a broader wealth display trend in China.
But if it's in Mandarin, of course, that might mean this mania in Singapore is going to spread to China. We don't know that yet. I've seen nothing coming out of China yet saying that people are queuing up to buy silver or gold.
Yeah, I interviewed King Kong the other day, Eric Young, and he said that he has a friend who bought a lot of silver for his house, stuff for his house, a few years ago when silver was below $20. And now with silver above 50, this friend of his is like bragging about the silver and really flashing his silver around because it's more expensive. And what Eric said, being Chinese, is that he expects that the higher the price goes, the more people are going to want it. It's going to be like flaunting your wealth. With silver at $20, it wasn't like worth it, but maybe at 100, 200, or even 300, it's going to be, could be the new gold, so to speak, in terms of flaunting what you have. Is this the experience you get as well from being to China several times and knowing the Chinese more than I do, of course?
Rising silver prices are turning a utilitarian asset into a status symbol. Eric Young notes that higher prices may drive social display among Chinese buyers, a behavior unseen when silver was below $20. The contrast between low-interest retail and sudden flaunting behavior illustrates potential speculative psychology tied to perceived wealth signaling. If this pattern migrates from Singapore to mainland China, it could inject real demand into a largely dormant market. Analysts should track anecdotal indicators, as behavioral finance trends can precede price shifts. Next, Mario Innecco and Clive Thompson examine first-hand observations in Chinese gold retail to gauge market sentiment.
Well, I was in China about a month, maybe a month and a half ago. I tried to. I mean, I went to a lot of gold shops. These are big, tall buildings. They're colored in gold. They usually have dancing girls outside, or maybe the face-changing routine to attract the customers. There were customers in the shop, but the shops were not full, which meant that as soon as I walked in the door, I was seen as a target, and a girl arrives immediately with a cup of tea for me and starts showing me their goods. The prices were very fair. For example, for very small bars, like 50-gram bars, which are beautifully decorated, it was about 13% over the international gold price, which allows for the workmanship and the sales tax. But it wasn't crowded. I wouldn't say it was crowded. And I talked to people, my wife's family, who are from China, and I asked them, "Are you interested in gold?" And basically, there was no interest, really. So I don't get the impression yet that there's any fever in China. And I also happen to be a shareholder in an international, it's Hong Kong and China, gold dealer company. It's quoted on the Hong Kong Stock Exchange, called Luk Fook Holdings, LUKFOOK. That share price has been up and down for years, but it's not right. It's not going through the roof as I would expect if there was some sort of gold fever in China.
Foot traffic doesn't always match price trends. Despite ornate gold shops and premium pricing only slightly above international rates, the lack of crowded stores shows muted retail enthusiasm. Conversations with locals and families suggest limited personal interest, corroborated by the flat movement of Luk Fook Holdings' stock price. This indicates that gold fever narratives may be overstated, with social behavior diverging from headline on volatility. Investors should weigh physical retail indicators alongside market pricing to assess real demand. Next, Mario Innecco and Clive Thompson look at how private purchasing habits in the West influence silver and gold markets.
Yeah. I mean, it's still early days. We don't have places like the one in Singapore here. Maybe up in the West End in London, the Sharps Pixley. But if you're going to buy gold here, you do it more privately. You go into an office. You don't want people knowing that you're selling gold. So I think that's maybe why. And people are doing it more online here. But I would say, Clive, that business picked up here in the run up to middle of October, because people always buy things when it's going up, and then when it corrected from like almost $4,400 down to like below 4,000. From what I've heard with people that I talked to, precious metals dealer, things slow down. So, yeah, people always chase things instead of, like you've said many times, doing dollar cost average or even just waiting for a big correction. In terms of silver here, I wanted to buy some yesterday, but I looked, the prices are like, you're paying like 60 pounds for an ounce, and the spot price is 42. And you've got a big premium plus the VAT. So I think that might discourage people, even though I think longer term you shouldn't worry about the VAT. Maybe I will buy some if I find a good deal.
Retail buying patterns are masked by premiums and VAT. The October spike in demand was fueled by momentum chasing rather than strategic accumulation. Even experienced buyers face premiums that push the purchase price well above spot, silver at 60 versus 42, adding friction for physical buyers. The muted online and office-based purchase culture highlights a subtle structural barrier for real demand. As Mario Innecco notes, short-term corrections don't deter true investors, but inflated costs can temporarily suppress grassroots participation. Next, we assess why 401k policy changes could redirect institutional flows into metals.
But Clive, I sent you as well, I think, I'm not sure if you got it, something about an executive order that President Trump signed back in August, and I'm going to bring it up
Oh,
because
yes.
I heard someone talk about it maybe on X, and very few people are actually, especially in the gold space, mentioning this. And it's yeah, executive orders, right? August 7th, 2025, democratizing access to alternative assets for 401k investors. And yes, let's have a look here. They're talking about that they want to make commodities and also it's right here, direct and indirect investments in commodities. So I would say that's like the physical commodity, i.e. gold and silver, or the mining companies, right? And they've got a lot of other stuff like I think private equity and everything else. And the U.S. Secretary of Labor has 180 days from August 8th or 7th, I forgot exactly, to decide whether this is like, yeah, to give guidance on this executive order. And then from then, which is the beginning of February, like providers of 401ks, which are the companies people work for, right? And also the fund managers, they will decide whether they want to follow this executive order. But
A largely ignored executive order could reshape institutional flows. The August 7th, 2025 order aims to democratize 401k access to alternative assets, including commodities like gold, silver, and mining equities. Few in the gold space are tracking this, yet it has the potential to unlock substantial capital if fund managers adopt the guidelines. With the Secretary of Labor given 180 days for guidance, implementation could begin February 2026, potentially directing billions into metals. As Mario Innecco notes, investor awareness of this rule remains low, leaving early movers a clear edge. Next, we examine how 401k mechanics differentiate from IRAs and what that means for metals exposure.
I had a look, Clive, 401ks, they're different from IRAs. IRAs are your own. Anyone can start an IRA and they can put, I think, $7,000 a year maximum. While a 401k, if you work for a big company, they will give you a 401k account. You can put up as much as $23,000, I think, and they will match it as well. So it's a lot. It's quite it's a good deal. And but unlike IRAs, where I think people who do a lot of gold and silver IRAs, they can't do it on the 401ks. So I think from February, it's highly possible that we could see a lot of money going into the mining sector from the 401k policies. And I think they've got about 9.3 trillion in there. I think IRAs have even more, 18 trillion, but the IRAs already let you put money in several places. I hadn't seen that until recently, even though it was passed in August. I think the focus was on private equity and people didn't realize it's also commodities. So just want your opinion on that.
401ks could become a hidden driver for metals investment. Unlike IRAs capped at $7,000 annually, 401ks allow contributions up to $23,000 plus employer matching, making the asset pool enormous, roughly $9.3 trillion. If the executive order is fully adopted in February 2026, this could channel a significant portion into commodities, particularly gold, silver, and miners. While IRAs already offer flexibility, the untapped 401k exposure represents a potential institutional inflow few are pricing in. Next, Mario Innecco and Clive Thompson assess how regulatory clarity could reduce risk aversion for fund managers.
I think the rules relating to the 401k are quite complex. And that the result of that is that some of the investment managers aren't that good at understanding rules. They've made mistakes, they've done things wrong, or they've innocently done things wrong in trying to make money for their clients. And there's been a lot of lawsuits where people have sued their 401k providers. And obviously that's creating a worry for other 401k providers in as much as they have drawn in their horns and they're being very, very cautious and just investing in very safe investments like government bonds and things like that. And I think what this is trying to do is to ease up the rules so it's less hard or less easy to fall into the traps of doing the right thing for your client and then getting sued for it. So yes, it obviously, I don't know if it actually, I haven't read the rules clearly enough to understand what the impact on gold is, but if gold was not previously allowed, my understanding is it's going to be a wider class of investments which will be allowed, maybe gold miners in the future. And hopefully by doing that, it means that those people who try to do the best things for their clients by investing their money perhaps in gold miners or whatever it is, won't get sued when it doesn't work out.
Legal fear has been a silent brake on commodity allocation. Complex 401k rules and prior lawsuits have made fund managers conservative, favoring government bonds over potentially higher return sectors like gold miners. This executive order aims to reduce litigation risk, broadening allowable investment categories, and easing managers' hesitancy. If gold or mining equities were previously restricted, these changes could shift long-term allocations. As Mario Innecco observes, regulatory clarity may unlock previously dormant flows into physical and mining assets. Next, we explore how investors may start questioning allocations in early 2026.
Yeah, and you said, you said already over a month or two ago that people are going to be questioning their fund managers in the beginning of 2026. You know, why haven't you put any money in gold and silver or the miners? I mean, Bitcoin is down like 1% year to date, and it seems like the focus even of the Trump administration and a lot of people on Wall Street is on Bitcoin, while silver is up almost 100%, Clive, and gold is up like 60%. And it's almost like it's not even talked about. And I saw it this morning, Clive, on the FT. The main story is about stocks, you know, not about the fact that gold and silver have done really well, but U.S. stock sets for double-digit gains in 2026, say Wall Street Bank. So bullish forecasts come despite recent jitters over tech spending and potential bubble in the AI sector. So yeah, it seems to me that gold, silver, the metals, and even the miners that are up even more, but I think still have a lot to catch up on. They're still forgotten, and I think eventually people are going to wake up and say, "Why are you putting some of my money in this?" And even if they don't put like everything in gold and silver, even if they put like 5 or 10%, it's going to make what this year did look like a picnic, don't you think?
Metals performance is being overshadowed by stock coverage. With silver up nearly 100% and gold 60% year to date, Wall Street and media focus remains fixated on Bitcoin and equities, as highlighted by FT coverage of 2026 stock gains. Investors may soon challenge fund managers on missed opportunities in metals and miners, even if only modest allocations of 5 to 10% are added, potentially magnifying returns in comparison to underexposed portfolios. As Mario Innecco notes, the market has yet to fully price in these sector gains. Next, we evaluate how small incremental allocations could change portfolio outcomes dramatically.
Yeah. I think my advice to any portfolio manager is you need to have something of everything, because when you face your clients 6 months from now or 3 months from now and you're talking about last year's performance, the 2025 performance, your clients are going to be wanting to hear about the good things you bought. If you bought something which went down, it doesn't matter. You can just ignore that. But you've got to have some good things in your portfolio. And obviously, this year, the two good things have been tech and the gold and silver miners. So if you're missing out on the gold and silver miners, you better get some. And of course, the problem with tech is it's had its bad days, and there's a lot of stories going round, which does mean that it looks kind of fragile. It's not for me to say that it's about to crash, but you only have to open up the social media and look at this, and the world is awash with people saying it's overpriced, it's ready to crash, it's going to happen next week. Then it goes down a bit, then it goes back up again. But, what I'm trying to say is you've got to have a bit of everything, so you've got some good news to talk about. And most investment managers do not have the gold mining sector, they do not have the silver mining sector in their portfolios, and they really should hurry up and get it.
Many managers are flying blind without exposure to metals. 2025 performance highlights tech and gold-silver miners as top contributors, yet most portfolios lack the latter. The volatility in tech is apparent. Social media buzz amplifies fears of overvaluation, while the metals sector quietly outperforms. As Mario Innecco points out, ignoring miners leaves clients without strong, tangible returns. Portfolio diversification isn't just academic. Missing key sectors can undermine credibility during performance reviews. Next, we explore differing philosophies on portfolio concentration versus diversification.
Yeah, and I mean, there are some, I think Stanley Druckenmiller, I guess, yeah, he doesn't think like that. He thinks that if you're really convinced about something, that you should go all in. But I agree with you. For someone's pension, I guess they have to be more diversified. And
Well, there are examples when you should go all in, and that's when you're 18 or 19 or 20 years old and you've got your whole life ahead of you. So if you lose it, you can make it back. But by the time you're investing for your pension, your 40s or your 50s, you have to be in lots of asset classes and not betting on just one, because you might get it wrong.
yeah, no, that's true. That's true. I guess it depends also on the person's risk profile. And Clive, do you? Yeah, I saw that we're not getting the U.S. Jobs numbers today. I don't know why. They've got an excuse, of course, that the government was shut down for so long, but they're already publishing other numbers. So it just doesn't, to me, it sounds like they don't want to bring out the really bad numbers, so they're delaying it. Could I be wrong, or what do you think?
Timing and age dramatically alter risk strategy. While Stanley Druckenmiller champions all-in conviction for early career investors, pension-age individuals require broad diversification across asset classes to protect retirement capital. Market timing matters too. Delays in jobs data may distort perceptions of labor strength and economic momentum. As Mario Innecco notes, relying on partial data or incomplete releases can mislead fund managers about underlying macro conditions. Risk profiles must guide allocation, not hype cycles. Next, we consider how outdated or missing data affects Fed policy decisions.
Well, I think it's true, because don't forget, to have the number, they had to gather the data, and if the staff were all sitting at home, they obviously weren't gathering the data. Therefore, the number doesn't exist, or if it does exist, it's a very flaky number because it won't have enough data in it. And I think the real problem we got next week, let's just say next week we have the Federal Reserve FOMC meeting on Wednesday, when they're going to announce probably an interest rate cut of 0.25%. But a lot of the data that the Fed would be relying on is now 2 months old. It's out of date. So they're, to some extent, still flying blind. They don't know for sure what the real inflation rate really is at the moment. It's supposed to be 2.8%. That's the expectation. But it's certainly not down to the 2% that they were hoping for. But the market seems to be convinced they'll cut the rates anyway.
The Fed is operating with a 2-month lag, yet markets anticipate action. With staff delays during government shutdowns, the accuracy of key economic indicators is compromised, making the upcoming FOMC rate decision partially blind. The expected 0.25% cut relies on data now 2 months old, raising questions about whether inflation truly sits at the projected 2.8%. As Mario Innecco highlights, the market assumes the Fed will act regardless, exposing investors to policy misalignment risks. Next, we examine the broader implications of politically influenced appointments on bond markets.
Yeah, I think they will cut, and the also the apparently the bond investors or the bond market is warning about against Trump nominating Kevin Hassert. I think that's his name, because they think he's going to just follow what Trump says. But Trump said he's going to. Well, a couple of weeks ago or last week, he said, "Oh, I know already who I'm going to pick," and people were thinking that he was going to come out with a name, but now he said he's going to wait until the beginning of next year. So he's keeping people like speculating.
Political uncertainty is creating market tension. Bond investors are wary of Kevin Hassert's potential nomination, fearing a politically influenced Fed vote. Delays in revealing the choice, now pushed to early next year, keep markets in a speculative limbo. As Mario Innecco observes, this uncertainty can drive short-term volatility even if fundamentals remain steady. Investors must weigh how political maneuvers intersect with interest rate expectations when positioning bond and equity portfolios.